Okay, well, welcome back to Rich Lessons podcast with myself, Sevetra, and Sheena. We're excited about the momentum of the podcast. We're excited about all the questions we're getting, all the correspondence. Just excited in general to be doing this finally.
Finally, as you guys learned in episode one, this was my entire pitch has finally come true. She accepted my pitch. And in fact, this is kind of going to be what we're talking about today, which is fundraising, bootstrapping versus VC venture capital funding, which pitching goes into fundraising.
Yeah, I kind of toyed with some names of this episode. I was like $55 million raise, would we do it again? And why we feel bootstrapping is still elite. But is bootstrapping still elite? I think so. What do you think?
I don't think we have a choice. Well, because fundraising is down. I mean, the numbers are horrible right now across the board. They have always been bad for women, particularly Black women. But I think numbers across the board have been bad over the last 2 years. So although I feel we're optimistic about 2025 and fundraising, I think you're kind of forced into bootstrapping, and it has its pros and its cons.
Well, let's talk about bootstrapping first. I think that most entrepreneurs today are bootstrapping their companies. Although raising capital gets all the headlines, there's
Yeah.
such a small percentage of founders, regardless of race or gender, that actually raise capital. So let's talk about bootstrapping first. I would love to hear your story, Sheena, about bootstrapping. Was it out of necessity? Was it because, like me, it was the only way you knew how to build a business? But what was your bootstrapping experience?
Similar. It was the only thing that I knew. So I actually didn't even know how to raise money when I first started. So my first company, Sheena Allen Apps, started in college. It was a mobile app studio. I was taking ideas and building apps. Of course, thankfully did really, really well. Um, I got started because I borrowed money from my dad. So I went to my dad and was like, "Hey, I want to build this app. Can you front me my student loan check?" And that's how I built my very first app. And as bootstrapping by definition is you are taking either your own capital and you're investing it into your idea, your company, and then as you make revenue, you're just reinvesting that money. And that's what I did. My dad gave me that loan, if you want to call it. I paid him back. First app came out, just continued to reinvest the money as a company made money. So mine was one, out of necessity. Two, I didn't even know about pitching to venture capitalists because I started my company as a college student in Mississippi. So it's not like the conversation of getting investments was even a thing.
Hmm. Yeah, I think the same thing for me. Um, Never even knew that the venture capital route was even an option. And ironically, I started my first business in college too. And really, we were just like bartering as college students. Like, I had a college classmate who knew how to create logos and do design. I had another one that knew how to do a website. And they were like, okay, I'll do it for like $100, or I'll do it for like whatever the price was. And that company was called Be Now. So Black News Our Way. That was like my first startup. And I went to my professor and I was like, oh, I'm starting this newspaper. And he was like, well, did you start an LLC? Like, did you go and make it legit at the Secretary of State office? I was like, what? How do you do that? Right? Like, I didn't realize that was a thing that I needed to go do. He was like, yeah, you're paying people, you're looking to get some advertising for your online newspaper. You probably need to go and get an LLC and file and do it the right way. And so he actually wrote me my first check. Crazy enough. So I don't know if that would be like early seed investment, but he actually gave me $250 to go get my LLC done at the Secretary of State's office. And to me, I was like, oh, wow, I didn't even ask for that, right? So big difference between having to go out and raise capital and ask people for money. He saw, here's one of my students. She's learned a lot from me in his history class. Shout out to Dr. Lennon Moore. And I'm going to help her out, right? And so that is literally how I started my first venture. my first business, but really it wasn't until Solid Ground Innovations where I bootstrapped a company to 7 figures and hired a whole team like full time, that I really understood how and what it took to bootstrap a company.
Yeah, it's well, I guess technically that 250 would have been a family and friends round. I mean, he was your professor, but I guess that would be a consider a family and friends round, but mainly bootstrapped. I it's crazy because when I left college, I left Mississippi and I went and spent time in San Jose, and it was just how I got even introduced into the world of investing or VCs. But sticking to bootstrapping, bootstrapping has its pros, it has its cons. You mentioned like you bootstrap a company to 7 figures, but it's time. One of the
Mm-hmm.
biggest differences in bootstrapping versus VC is timing to scale, the money to scale. Um, but I think once again, there's the pluses and the minuses. So if you had to say the plus for you in deciding to bootstrap, like what would you say?
So bootstrap, you really do have full ownership and control, of the destiny of that company, right? So whether for better or for worse, whether that company takes off and you're able to hire people or you're able to make money, you see profitability, you're not having to report to shareholders, you're not having to report to a board. And so bootstrapping for me, not only was it all I knew, I kind of missed that level of control when I ultimately went and raised capital, right? And my first company, Solid Ground Innovations, was profitable. It grew naturally, and shoot, I started off literally with $500 contracts, $500 a month contracts, helping people with their websites and their digital media presence, and their marketing footprint, and doing all their advertising, and the company just began to like blossom and grow from there. And as I kind of told people in another episode, I took that money, and then that was actually the seed capital for my venture back company. And so really just having that type of autonomy, to make decisions, to also, I think there's a different level of like discipline that's also required when all the money that goes into the company has to be used. Every dollar has to be used the right way, and to continue to grow business and pay bills and pay vendors and do the work. I think that's a big difference as well. And not saying that you don't have those same just criteria of discipline that's needed for a venture back company. I do think it's different, right?
Oh, for sure. I mean, I won't lie. When people say like, "What's one of the biggest differences?" or like, "What did you miss?" or "What did you enjoy?" Not having to answer to anyone, because as we know on the other side, you're sending monthly updates and all these different things. Like, it's on you. Now, mind you, for some people who are not very disciplined, maybe that is not the greatest thing because you're kind of holding yourself accountable. And if you're not someone who's willing to take accountability, you're not very disciplined. I can see how and why that might be on the negative side versus on the positive side. But I did like the fact that it was on me. It was up to me if the company made it or didn't make it. I didn't have to answer to anyone else. So
Mm-hmm.
similar for that. If you have to say on the other side though, the negative, if you want to say sides of bootstrapping, what would you say?
I mean, there's a lot of negative sides to bootstrapping. One, running out of money, right? I think that having cash flow is critical in bootstrap companies, and that cash flow comes from your revenue, right? And so for me, I did a lot of contracting with the government. And if you know about contracting with the government, sometimes 60, 90 days before you get paid out. But if you have subcontractors, those subcontractors, you can either make them wait, or you could pay them with inside of their 30-day timeline, or what you're naturally paying them. And for me, more often than not, for my smaller subcontractors, I would actually just foot the money, even before I got paid, right? And I think that that was just like how I ran business, but it's very difficult to do that, And then also the challenges to secure loans, particularly when you're just starting out. There's a lot of conversation around SBA loans and these other vehicles, but it's not easy to get that, right? They're accessible via you having like years of business, years of good financials, to be able to show banks, to be able to show lenders, to even be able to access that additional capital, credit lines, right? So all these things are like relevant. And so I do feel like there are much more just limited resources for bootstrap companies. But what have been some of your personal experiences from bootstrapping?
I think you're spot on. So it is the limitations around it because you only have what you're making and or personally what you're putting up. That is taking a second mortgage out of on your home. That's selling personal items, especially if you don't have revenue coming in yet. And I will say, I think one of the biggest things about bootstrapping, I guess we're talking about more of the negative side of bootstrapping is, for one, businesses are so unpredictable. Now, a large amount of businesses fail, and because you're putting so much of your money into this company, if that company fails, like that's not investors' money, like that is your money. But at the same time, it also, I guess you would say, makes you go a little harder because like this is my money. Like if it doesn't work out,
Mm-hmm.
you pay to play, as far as like you gotta put some money in to play the game, it doesn't to follow your dreams, to bring your idea to life. But not having that money to grow super fast, that money coming out of your pocket, your bank account, what does that mean? Am I going to eat bologna sandwiches because I'm putting so much money into this? And that was me. Like we were making money, but because I was putting so much money back into the company, mind you, I'm 21, I'm 22, I'm doing
Right.
without a lot. From a personal standpoint of like what my friends were doing, they were going out of town, they were just blowing money on crazy stuff. I'm like, no, I got to put this money into this business. So the limited resources, I would say the slowness of growth, but it definitely is not the same as someone writing you a check for 5 million when you're just having to put 5,000, 10,000 monthly revenue back into a company.
Absolutely. Now, we both transitioned to raising capital at some point. What did that transition look like for you? And um, did you start off with angel round? Did you raise from friends and family? Did you kind of do the traditional route to raising capital?
Yeah, so also for those who don't know, the traditional route when you're thinking of raising money is usually family and friends. I know everybody doesn't have family and friends that can give them money, but it's usually family and friends, angels. Now we have what's called super angels, but angels used to be someone who could write you a check for 5,000, 10,000, 25,000. It wasn't a life changing amount of money, but for some people, 5,000 made a huge change in them building their
Yeah.
company. So family and friends, then you have angels, and then once you get into venture, you also now you have pre-seed to seed to series A and so on. And there's some others like crowdfunding and family offices, but the traditional route is usually family, friends, angels, and then venture. For me, it was interesting because it was two sides. One side was I kind of, I guess, technically went angel, but it came from the fact that there were investors who saw me build Sheena Allen apps. And I
Mm-hmm.
bootstrapped that company, but again, we did really well. And so I had investors who was asking in my first company, hey, are you taking investments? Are you interested in raising money? And I just knew that that wasn't what I was going to consider my home run. It was my learning company. Like it was what I was going to learn from my mistakes, my money, if or when it failed or whatever I want to do with it, it was 100% on me. It wasn't something I wanted to raise money for. However, I kept those relationships. And so when CapWay came to be and I knew I was going to raise money, I kind of went back to those same people and said, hey, now I'm raising a venture backed company. And the reason CapWay was a venture backed company, not because I didn't love bootstrapping and having that control, it was fintech. And so, one thing I want to say is that when people have the decision of bootstrapping or raising VC, there are some industries that you're just not going to bootstrap unless you come from a super wealthy family. Like, I can't bootstrap building a bank. It's highly regulated. Some of these vendors require $2 million in the bank before they even talk to you. So me raising money for CapWay was by necessity, but that first round came from investors who saw me build my first company.
Yeah, I've talked about how much I invested in my first venture-backed company, to the point where I also faced the necessity, just because building software was not cheap. And then also carrying so many hats. Like when I was bootstrapping, that was kind of the norm. But now I actually needed people who had high expertise in certain areas that I just did not have expertise, nor would have it have made sense for me to go out and try to learn that, right? I'm not a technical founder, so it didn't make sense for me to go out and learn how to code. Although I will tell you, I actually did try to go down that path, and then I realized, like, what am I doing? Like, let me do what I'm the best at, right? And I had to go back a little bit because that boat had sailed. But I was recently talking to a founder who was just starting out. We were connected via my International Women's Foundation group, and she's out of Tampa, Florida. And so she was basically asking me about raising capital. And she's like, I've been talking to other people, and they're like, yeah, it's like friends and family. Just go ask your friends. She's like, I cannot ask my friends and family for, this type of money. They just don't have it. And I was like, you need to broaden what you consider your friends. Um, these are potential colleagues of yours. These are individuals you've met maybe in business, right? So this woman was working in corporate America, and so she had access to probably high wealth individuals. But the idea that she would ask these people for money, that just never like
Cross her
that
mind.
just never crossed her mind or like dawned on her that that was appropriate, right? And I was like, yeah, like these people who have high net worth assets, and they have money that they're probably investing somewhere, are your most likely bet to raise capital. And so she started thinking about that. And for her, I had changed how she was thinking about and who she was thinking about raising capital from, and who she could, right? And so I think that people have to broaden what they think are their friends and their family. These are individuals that are in your network, right? Maybe a degree or two separated, but they know you from something, and you could probably get to them and have a conversation, right? You could potentially pull together a deck and pitch your idea, your business to them in a way that they may be interested. A lot of individuals who are high wealth, and I say even like middle class, maybe they have the ability to pull money from somewhere, and they're interested in investing. They're interested in breaking into investing, and that might be from people who can only write $5,000 checks or $10,000 checks. But it may be people who can write larger checks, right? When you think about this idea of super angels. And so I think that when people are at a point where they're have a necessity because the product in which they need to build is so expensive that it will require them to raise capital, and their market is so big that if they were able to raise that capital and then put it to work successfully, that they would then have a multi-billion-dollar company, right? And so think about that when you're trying to decide, is it right for me to raise capital? Should I raise capital? Otherwise, let me tell you how many times people come to me and they pitch an idea where I'm like, you can bootstrap that.
Yes.
You can go
And
ahead and
there's
bootstrap that, okay?
the thing that no one talks about, because you said it earlier, the headlines always talks about raising money. Company X, person X raised 10 million, 20 million, 200 million. So that's always the headlines. And so when you see startup founders, they think that's the route I have to take. Like that's the one that's going to get me all the glory, going out and raising a whole bunch of money, which is actually not the case. The part that they don't see or no one talks to them about is every check that you take, every time an investor says yes and you agree to take that money and you sign those agreements, whatever type of agreements it is, and maybe it's different from this episode with safe, convertible notes, price round, whatever you sign, your baby becomes less of your baby, aka you're diluted. Equity is coming out away from you and going to that investor. And so if you can bootstrap and make revenue and make money and keep your money, please do that.
Yeah, I mean, at the end of the day, everybody starts out with 100%, right? Whether you bootstrap or you raise capital. And if you raise capital, you're giving up that percentage, right? And also, if you bootstrap, you can still give percentages of your company to your employees. And when you raise capital, you'll also give a percentage of your company to your employees through what we call options. And so I think that people have to really think about that when they go out to raise capital, when they go out to ask this friends and family for support. And also, I just want to remind people, if you have to raise capital, that nobody likes to ask people for money. I think that somebody wants like this cheat code that allows them to not have to ask people that they know for money or people in their network. And it's like, you come ask me for money because you don't know me, but you won't ask the person that you know for money and for capital. Although we might be on the same level of wealth
Yeah.
because you know that person. No, you actually need to start with the person that you know.
Yeah, I think some people are scared to ask because we see it from a true family and friends issues of like the friend asks you for $100 or $1,000, and the mom or the brother or the sister, whatever, the family member, the friend doesn't pay that money back, and then you have a
Right.
falling out over $500. So I think that's the mentality that people also think when they say family and friends around. It's like, if I go get $100,000 from my coworker or from this person within my network, and the company fails, like, is that going to ruin my relationship? Am I going to be embarrassed about that? And I think that's probably one of the biggest issues when it comes to family and friends. But to your point, even if you bootstrap, there are ways you can and will be diluted depending on how everything is set up. You have to make a decision. So we're talking about, transition to raising capital, especially at versus bootstrapping. And I always tell people, one, what industry are you in? Do you need a lot of capital? Is it a capital intensive industry where you need money up front? Can you bootstrap it? Is it a company that is not even VC backable? And trust me, a VC will tell you when you pitch, they'll be like, this is not something that needs to be VC backed. It just doesn't fit. But also, to piggyback off what you said, everybody starts out with 100%. Don't be afraid to raise and or give up equity because you want to keep 100%. I was always told 100% of zero is still zero. So, I mean, I don't know. Bill Gates owns, and maybe it's a bad example because it's a public company, but if Bill Gates owns 2% of Microsoft, that's still a heck of a lot of money versus him trying to raise. I mean, maybe if he owned 100% and didn't want to give up anything, he would never be or have gotten to where he is now. So I just want to say, don't decide if you're going to bootstrap or raise money based off wanting to keep 100% of your company, because you're going to give up equity either way. It's just that consider that you're going to give up equity every time you do take a check from an investor, but 100% of zero is always zero. So just make smart decisions.
And I want to go back to, again, raising money for people that you know and for like this friends and family angel round. Um, this also brings up a conversation around raising capital from what we would consider sophisticated investors, right?
Yes.
And so oftentimes, first time angel investors, people who've never had invested before, may not be sophisticated investors, right? And so if I loan you money, then I expect that money back. If you invest money in my company, then you risk losing that money.
Yes.
And it is important for people to have those conversations with those individuals who have never really invested before but are interested in supporting that founder, so that you end up maybe it not working, right? Because most businesses do fail. Like, that's just the reality of any thing that you build, anything that you start, that you have a high chance of failing. And so investors need to know that this is not a loan. Like, you have the liability of investing something that you may never see again. And so I will say, like, people who I have invested in, and I've seen founders who will try to literally keep raising money and keep trying to keep a company afloat because they don't want to disappoint their investors and lose their money. And I thought it was like, yeah, I think I'm trying to find a place for this company. I'm trying to figure it out, trying to raise like little chunks of money. And then ultimately the business went out. I had to tell founder, like, you don't want to do this anymore.
Yep.
Like, you need to go ahead. It's okay. It's okay to wrap it up. People will be okay, including myself, who lost their money, right, with this
Yeah.
company.
That was
But
my story with CapWay. I continued to put money into the company because I didn't want to disappoint investors. And it took investors who I was closer to in its process, and I had maybe two or three who was just like, we literally lay out our fund because we know at least 70 to 80, potentially 90 companies are going to fail. So if you come to
Yeah.
us and say, hey, we're going to dissolve, it didn't work out, it's just a check mark because we already knew that a large percentage is the number I was always given is if you take $1 million, if an investor has $1 million and they invest in 10 companies at $100,000 a piece, they know that 6 or 7 are going to fail. That's 700K off the table, never going to see it again. One
Yeah.
or two are going to sustain themselves. They're going to do okay. They're going to stay alive. They're going to be okay. And you're usually going to have one out of that 10 that's going to be a unicorn, a home run, and it's going to make up for all the other ones that didn't make it. And so a lot of founders do that. And I am guilty of that. I definitely did not want to disappoint my investors to
Yeah.
say it's just not going to work. And I put a lot of my personal money into trying to keep it afloat, only to realize in the end that the investors was kind of like, it's kind of part of the process.
Yeah, and I think that to that point, right, there's appreciation for founders who continue to like push through, right? Like we're gonna continue to push through. But there is a point where even founders know in the back of their head, like, dang, I'm probably at the end of this road, but I'm still trying to push through. And they're continuously like not only wasting time that they could probably be spending building something else or building something new or building something that they were like, oh, I learned from everything, all my experiences of this company that wasn't successful, and now I'm going to take that and do something else or whatever that may look like. And so I think there is some definitely glory to be said of founders who push through. But I think there is this thought process for investors who are like, all right, do we have, if we pivoted again, will this work?
Yeah.
Right?
And,
Because
and people do pivot a lot.
yes, and
Sometimes
it
to the point
works.
like
It
it's
works.
just not going to work. But you are spot on because I for sure had several investors tell me, we appreciate the fact that you tried to sell the company. We appreciate that you tried to find ways to keep the company going. Because a lot of founders would have been like, oh well, cool. It ain't my money. Like, and what's crazy now is the truth is some of those same investors has asked me in the past, they'll ask me current day, what are you doing next?
Yeah.
Because I was the founder who kept pushing through. Yes, CapWay didn't work out, but I like you as a person. Like you showed me that as a founder, as a CEO, like you're worthy that I'll put another check behind what you build next.
Yeah. And you think about, yeah, y'all understood how many companies that you see are successful today, how many previous companies of those founders were not successful is crazy. And those founders go on to raise more capital. They go on to build new companies. They go on to like, again, use the lessons of their previous company that didn't work and then go on and build successful ventures. And so it happens so often, and that people get so caught up in the glory story that they don't even realize that that founder actually had 3 companies before the one
Yeah.
that popped actually popped. And I do think that's an issue for like sometimes for women founders and minority founders in general, is because sometimes they will fail at something and they will not do something else because they feel like, oh, I tried it, I failed at it. When in reality, it may be that thing didn't work, right? That thing failed. But guess what? Now, if you take those elements and you take those experiences, and even the resources, the network that you gained through that journey and apply it to something else, then that next thing might actually be
Yeah.
successful. And so that in itself is like a rich lesson that I have learned over time.
So in your experience of raising money, and you raise over $50 million. Of course, every round is different, because you go from pre-seed or seed, and then you get to like growth stage, and of course, it is very different. What would you say would be your advice and or your lessons in raising from just taking money, easy money because I need it, and or deciding no, if it is not strategic or if it is not from an investor who knows my industry, I am not taking this money.
Yeah, so I don't think any money is easy money. All money, comes with some hard behind it. And so for me, and kind of to explain, because I know we're talking terminology that some people may be listening and they may not even realize what we're talking about. And so we were talking about friends and family, which also can be considered like an angel round. pre-seed round, which is considered also angel family, then seed round, which was my actual first round that I raised institutional money. In my
Which is
seed
different. I want to
round.
say it has changed. So, in change in the sense of pre-seed definitely was not even a thing, I don't know, 10, 15 years ago. And then it
Oh
became
yeah, it
really
was just considered
popular.
angel.
It
Yeah.
became really, really popular maybe like 10 years ago. And that's when institutions, financial venture institutions actually started getting into pre-seed. So it used to be when you raised venture capital, you went in to raise seed capital, point blank, period. And then you had some venture firms to say, no, we're actually going to start doing pre-seed funding, which at one time was not what venture firms did. You went in there for seed, not pre-seed. And so a lot of venture firms now do pre-seed, which also has changed even in 2025 because
Yeah,
pre-seed
I
even,
love to say a pre-seed is a joke. A pre-seed today is
yes,
a seed round.
it's
Like,
not the
let's
same.
be
So a
real.
pre-seed, even when we were doing it in 2019, you didn't have to have traction. You did have to have a true foundation of something, but you didn't have to have 20,000 customers or revenue. It was truly considered pre-seed. If you're trying to do pre-seed in 2025, it is not the same. So I just want to put that out there because pre-seed, even pre-seed has changed from the original, I think, definition even 7 years ago.
So to that point, I raised an angel round, which I consider an angel round, which people consider pre-seed also. And then I raised a seed round. So I never raised anything on paper that said I raised a pre-seed round. But historically, what I raised would have been considered a pre-seed round by any like measure. I can tell you from right now, right, actually going through it, pre-seed today is a seed round.
Yeah.
That's what it looks like. And so I do think that there are founders who are out here raising and they're like, oh, I'm raising capital and I'm looking for this valuation at a seed round. And I'm just like, there's just no possible way. Like, this is not going to happen. But I think that people are still living in 2020 and 2021 when you had these mega rounds and people had such a little bit of traction and they were able
Yeah.
to raise so much money. Today, we are seeing a market that is rewarding people tremendously and with a lot of money for a lot of traction. And so I don't think that, I think it's very difficult for a company unless you are a founder who has had immense success and you already have investors locked in to raise money off an idea. And even those founders aren't necessarily raising off an idea because if they had that much traction, et cetera, trust and believe, they had already started something and were already building it. And now they are just presenting it to investors to raise capital for it. And so I do think that people need to kind of change their mindset around raising capital and know that the bar has risen substantially and it favors investors today more than it
Yes,
favors founders 10 times over
for
than
sure.
what it was like back in 2020, 2021. And that is just a shift in the market in general.
Yeah, the days of 2021 are long gone. Okay, sorry, I got you off track. You're explaining terminology. Sorry.
So I was kind of explaining the different rounds, right? Also there's predictions around people might raise a seed or a series A and never have to raise again, right? And they're just using money to continuously fuel the profit and to fuel their company to grow larger, but they're never actually running out of capital, right? And so people are looking at that as a great sign of companies to come or companies that they're looking for or what makes those companies attractive. And I'm not just saying that, I'm telling you what investors are telling me today.
Yeah.
Of what entices them or intrigues them about companies that they're looking at. Being able to do more with less. And I mean like less people, less engineers, more product, more users, more revenue.
And
And
FOMO
so,
is real with investors. Like they never want to admit it, but it is true. Investors want to invest in companies that, to your point, don't need the capital, or they reach out and they want to invest in that capital, and then a founder says, "Thank you, but no, thank you." Like,
right.
we don't really need the
I don't
money, or
really
we're
need
going
the
to go over here
capital.
to somebody else, or investor A fits more of our market. You want to go more strategic route. that investor will call and beg you at that
Yeah.
point to take their money, which is the craziest thing ever. But it's
Yeah,
very true.
that's just like that's the market right now. And so yes, you're seeing like big deals still getting done, but I'm seeing larger deals and fewer deals, right?
Yes.
And so more money in fewer companies that are coming online. Sheena, you talked a lot about AI as well. That is like definitely AI and data are like the hot topics right now in investing. But from my standpoint, to like really get to your question about my fundraising experience, because I've raised so much capital, is that I would do it differently if I had to do it again. I talked a little bit about this. However, I just didn't know what I didn't know when I was raising capital. And so I went out to raise my angel round. I was giving some support by like attorney with how we do that. We raised that capital on a safe, right? So secured agreement for future equity. When I raised my seed round, we actually converted that safe into equity, probably converted too early, to be honest. We raised about $2 million on that. Then Series A, we raised during the pandemic. When I tell you during the pandemic, like we closed on like March 21st. Like it was like dead in the pandemic and everything was shutting down. And it was so bad that one of the investors who had a $3 million check of the $8 million called the day before we were about to close, and they said, we don't know what's about to happen, so we're not going to invest the money. My other investors had never seen that before. They're like, this has never happened before. Now, eventually those investors came back in, but I honestly think it was a little bit of pressure too, because what happened after or during the pandemic, the rise of Black Lives Matter, the rise of, the post George Floyd, just conversations, right? And so I actually think that one, they came back in because the company was doing well, and they were like, oh, okay, you guys, you survived. So let's go ahead and put that money in there. But also, I think they felt like it would also look bad if we pulled the money from a Black founder, right?
Yeah.
But trust and believe, it was more of the company survived the
Well.
pandemic and kept growing. And so we'll go ahead and put our money in there, but we're going to wait and see. And they did wait and see all the way until July. So they didn't even put that money into the company until July. Now think about that, because we had created all of our financials around the $8 million. And so we kind of went into like, during the pandemic, we're trying to see how layoffs are going. We're trying to see if we could still even get new contracts. We're trying to do all these things. We're also trying to rework the financials and the budgets, etc. And so it was like chaos because of that. And then we raised our Series B, and our Series B changed the dynamics of the entire company completely, just because we had completely new board, new investors. And what it taught me is more doesn't mean more, right? And more doesn't lead to more. And I said this in a previous episode that I would have stopped at Series A and I would have looked for people to acquire the company. Now, I will tell you, over the course of those valuations and raises, I feel like our valuation was like spot on for the market. We probably wouldn't have got those valuations into today's market for sure. But the company was growing hundreds of percent year over year. So we were definitely inside of the portfolios that are investors. We were like one of the top performing companies, hands down. But because of that, I feel that there was intense scrutiny, and not even intense scrutiny, but it was almost like, y'all can't fail. Like, we're counting on y'all. Y'all got to return us this money. It was like that type of pressure that you were kind of working inside of a vacuum that was very just like intense and very much so like Big Brother watching down on you in a box. And so, needless to say, I wouldn't say I would not raise capital again, but I think I am more of the mindset today that raising capital to continue to fuel growth where you're not running out of money is the best method, and the method that I would take and will take in the future if I ever raise capital again.
On your journey I'm curious of this. How many no's did you get? Because fundraising is extremely tough, and no is part of the game. I'm sure you don't remember the exact number, but if you have to guesstimate how many investors you pitched to and how many no's you got.
So this is not gonna be the answer you expect, but let me tell you why. When I hear founders say I got 200 no's or 100 no's, my mind goes to 200 investors. Like, you can reach out to, you have talked to 200 investors. You have the contact information of 200 investors to actually get on the phone with so they could tell you no. Like, that was amazing to me, right? And so I just didn't know that many investors to have 200 no's, nor could I have gotten in front of, nor did I get in front of 200 investors to even have 100 no's, right? And so my number of no's is actually much smaller. So say through Resilia, we pitch to 30 investors. Let's say we pitch to, I'm going to even raise a number. I'm going to say we pitch to 50 investors over the lifetime of me raising capital for, and I say I pitched to 50 investors over the lifetime of raising capital for Resilia. I would say 20 of those 50 invested.
Okay, that's a good number.
But could have been 200 and I got 150 no's. It could have been, but I didn't know. I didn't know those investors, right? And so that was actually a discredit to my discredit, right? Because had I actually pitched to more investors, had I met more investors, had my network been big enough to reach more investors, then who I actually selected probably would have looked different too, right? And so a lot of times I had investors reach out to me and wanted to invest in a company. And I was like, oh, that's cool. Like, you want to invest in a company? Like, and so they look at the numbers. They're like, oh yeah, we actually reaching out to me on LinkedIn wanting to invest. So I didn't have I pitched to 300 investors and 250 told me no, or 289, 299 told me no. One investor told me yes. That was not my story because I didn't know those many investors.
That's interesting. I mean, that's actually not a bad number at all, because I definitely have seen, heard, and know people who have gotten the 50 no's, 100 no's, and a lot.
I think that's amazing. Like, to have a Rolodex of 200 investors, that's crazy to me in itself. So, have
I mean,
glass.
I don't think for CapWay, we pitched to too many people. In the beginning, we did. Unlike you, I did. But it was because the no's in the beginning came, and this is a rich lesson for those who are in an industry that people don't know too much about and are deciding who you're going to pitch to. In the beginning, I was pitching to people about an unbanked community in America. And a lot of these investors had no clue what an unbanked community would even look like. Is there enough money in this market? Because an investor is all about how big is the market, how much money can you make, what are the projections, what are the possibilities. And usually when I talked about people being unbanked, those investors immediately equated that to being poor people, which means there's no money in that market. And so a lot of the no's early came because I was pitching to the wrong people, which is a lesson that I would give entrepreneurs. Like, don't go pitch to an investor just because they are an investor. Try to find investors who understand your market and who will be good investors. And so once I became aligned or found investors who were aligned with what we were doing, they were fintech investors, they were social impact investors. The number of no's definitely came down. But that lesson in getting to that was understanding that just because someone is an investor or willing to take a call, your chances of it being no, if you have to educate them on what you're doing or on your industry, the chance of that being no is definitely elevated.
Yeah, for sure. And here's the other thing, and this may be different for some people, but for me, if I start giving a lot of no's and I'm like, I need to go back to drawing board, or
Yeah.
I need to go back and get some more traction, right? Because I'm always conscious of like my time, and how much time I'm spending pitching investors versus building the company. And so if I get too many no's, like a string of no's, and a lot of my time has been like sunk into raising, sometimes I'll take a step back and I'll say, let me give it another 3 months, or let me go and see what I can do without raising this capital for the next 3 months. I think is when founders have their back against the wall and they have to raise capital or they're going to die, or they think they're going to die.
Yeah.
And
And
so
that's
they're
the most expensive capital ever. When
yes,
investors know you are about to die, and I speak from experience with the CapWay, when investors know you are close to dying and you need that money, you need that check, that is the most expensive money you will ever raise.
yeah, for sure. And I think there are other questions that we constantly get. What are some quick questions that you get from founders? One for me is around ownership, right? How much of the company should I own? How much should I give up per round? Generally, people are giving up anywhere between 15 to 20-ish% every time they raise of their company, right?
Yeah.
It really does just depend on the valuation. But expect to give up more when you have less. That's for sure. Any questions that you get from founders that's like, oh, I always get this question from founders?
I think one of the things is more so when we're having a conversation and they'll ask, what advice can you give me, as I go on this journey? And my advice is always, whatever you think you need to raise, whatever that number is in your head or that your projections told you, times two it at minimum, because you're going to run into expenses that is, especially if you are a first time founder raising money for the first time. There are going to be expenses that are going to come up that your projections did not tell you. Because even though investors do ask for those projections, especially in the pre-seed round, which once again we talked about has changed a little, investors aren't asking a first-time founder in a pre-seed stage for projections for the purpose of the numbers going to be true. They know those numbers are definitely not what's going to happen. It's more so that you at least do the homework on the company, the possibilities. They know the numbers are not going to be exact. But as a founder, I'm telling you the numbers are not going to be exact. And you are going to come across things that you did not account for. So if you said it's going to take me $2 million to get this thing built, deployed, and get my first million, you're probably going to need $4 million to do that. Because it's going to take more time and more money than whatever you think it's going to do, whatever it's going to take.
Yeah, for sure. And also, revenue grows companies too, guys. And when I tell you that people need to put more faith in revenue and get into the revenue lines, you need to put more faith in that revenue and get into those revenue lines so you're not dependent on the venture. Final thing I would say is adaptability. So learning to pitch to different audiences. And so how you pitch an angel may look a lot different than how you pitch a venture capital, and how you pitch a sophisticated investor is definitely going to look different than how you pitch someone that is unsophisticated. And so that's, the advice I would give for anyone looking to raise. And again, I still feel bootstrapping is elite if you can do it. What those numbers look like for women, for Black women particularly, what the average revenue of a Black woman-owned business is like 36,000. That's not enough money.
Extremely low.
So we got to get those numbers higher if we're going to bootstrap.
If you were to say I'm going to raise again, and or when you did raise, as we close this out, my question to you in closing is, what made you say, or what would make you say no to an investor who wants to invest?
If they're not there for like the long-term vision, and if they're not there for me kind of leading the vision and direction of the company, I always think about individuals who are like, if they're going to be with you through the good times but not with you through the bad times, right? They want you when you're a hot company, but when you're not a hot company, they don't want you anymore.
Yeah.
And so I think about those things with investors. And so now I look at investors and who they have invested in before. Previously, I didn't really talk to prior founders of investors, right? That is something that I do for sure and would do and would advise everyone else to do for taking money from investors. And I think there's this like belief, particularly when the market started shifting, is that if somebody's offering you money, just take it. And that is definitely not the way I want to raise capital ever again.
Yeah, and I asked that question because I want founders to know you have the power to say no. Like you don't have to take a check because an investor offers you a check or because an investor wants to invest in you. Make sure like you are aligned with that investor. My no to this day will always be if an investor pretty much lets me know and I'm going to ask questions. If they like to micromanage, it's a no for me. Please don't call me every week and ask me for an update. Like it's probably not much has changed from 2 days ago when I talked to you. If it's a big update, I promise you, I'm going to inform you. And yes, as founders, we are responsible for giving updates to investors. But some investors are really big on control and micromanaging, and that is a quick and easy no for me.
Yeah. And so I think that we've said a lot on this episode. There's more to be said, there's always more to be shared. But we will definitely hold that for another episode. And, you know, everyone that's listening may not be a founder, entrepreneur, or someone that's bootstrapping or looking to raise money. Somebody listening, maybe somebody that wants to actually be a sophisticated angel investor and invest. And so we'll definitely talk more about how to invest in companies. I've angel invest in, I have in several dozen companies, looking at a few deals now. I'm an angel scout for Female Founders Fund. And so we're speaking from founders, entrepreneurs, but we will come back and definitely speak from the side of investors in the near future. But until then, any parting words, Sheena?
Stay crazy. Investing, fundraising. I said on a previous episode, I'll say it again. Fundraising, I personally call it hell raising. But stay crazy, do your thing, build, create, get it out there fast, build fast, fail fast, just go.
All right. And on that note, we're out. Thank you, everyone, for joining.